Hey folks, Tuesday afternoon, it's 4 o'clock, time for our barometer readings webcast. I want to thank everybody for joining in today. I've asked James Callahan once again to jump on to make a couple of comments on some companies. It's an interesting week. You know, 1 week ago, we were heading into this election. We thought there were some clues that the market was giving us on what the outcome might be. That was based on, what had been leading the market in the weeks coming into the election. Very often we say that, a single event doesn't change the way the market behaves. Sometimes it can accelerate things. Sometimes it can put a damper on things, but there's a lot of factors that drive returns and drive movement. And it's important to watch for changes and signs that something's behaving differently. The reason we do these webcasts every week is to sort of just reduce the action from the previous week, see what's changed, what hasn't, make sure that our portfolios continue to be aligned with what's happening in the market, and frankly, to be transparent with you, our clients, and folks that are following along at home as to what it is that we're doing and where we see opportunities and risks in the portfolios. So as usual, we want to start today with a top-down view of the world. Start with a very large view and make it a little bit more granular as we go along. Our view is that we've been in a bull market in stocks really since 2013. It seems like a long time ago, 10, 11 years now. But the period between 2000 and 2013 was a long, drawn-out affair with lots of heartaches. A very difficult period through the tech wreck, which of course actually spawned strength in some other areas of the market. As we used to say, the old economy lifted while the new economy sold off. And of course, we had some pretty benign periods, and then coming into 2007, had difficulty in financials. Of course, it washed through the whole market and probably caused the biggest major disruption that I can point to in my career, other than the very brief crash in 1987, which looks like a pimple on this little chart. But when we look at the more recent markets, this is the end of 2013 when we started a new structural or secular long-term bull market for stocks. That bull market has been marked along the way with some interruptions. 2015-16 was really driven by slowdown in China, which frankly, they're just working at getting out of today. 2018 was a taper tantrum, the Fed trying to reduce the size of their balance sheet and the market disagreeing. 2020, of course, was the COVID crisis. And this bear market between 2021 and 23, where over 25 months, the market went down a little over 25%. And in time and price was pretty typical of what you'd see as a cyclical bear market. So the market's been marking its way higher since January of this year. We're 11 months in. A lot of people talk about how much the market has gone up. Frankly, I look at the amount of money sitting in money market funds and treasury bills, and the number of people who are afraid of the things going on in the world. And I think to myself, by the time they decide that things are all clear, maybe it'll be too late. But frankly, in between these cyclical bear markets, you get a long run up in price. We talked about the fact that if the market made it to a 2-year anniversary, and it's been 2 years since October of 22 when the market bottomed, the average bull market was 5.5 years. So there could be a long way to go. We don't know until we get there. But when I look at under the microscope, we've been making this series of higher lows and higher highs ever since. And we've had lots of periods to pause and refresh. This past week was a big week. Market really jumped. In fact, the 2.5% that we saw post-election is the largest post-election reaction since 1950. Now, that really shouldn't be a huge surprise. The market was up a little over 17% coming into the election, and we talked about the numbers. When the market is up 17% coming out of the month of October, November, December tend to be quite strong. So you add more data, and we got a strong post-election reaction. And when we look at post-election reactions, when you had positive reactions, 2 days out, 10 days out, 20 days out, the market was strong. And similarly, we talked last week about when the market comes in weak, it often follows through weak, which of course has not been the case. So when we look at the equal weighted index, again, a series of higher highs and higher lows, we made new all-time highs over the past week. So is it possible the market can pull back and fill some of these gaps that have been left behind? Of course it is. But in general, we've talked for some time about the fact that looking forward, the biggest 7 stocks become less important from an earnings perspective as we see through the course of 25, the rest of the S&P really contributing from an earnings perspective. So on the QQQ, the NASDAQ 100, heavily tech weighted, it also made a new all-time high. That's great because there was a risk here of a double top. And we traded through there. When we look at the mid-cap part of the market, this is a mid-cap ETF, the XMMO. We're looking at weekly bars here. This was the week last week, quite a week. And we've talked about mid and small cap stocks being interesting ever since we had these 3 very strong weeks in the late part of August. That bread thrust where a very high percentage of stocks were up over the course of 3 weeks. And when that had happened historically, you tended to have a period of outperformance. And we also talked about the fact that the Value Line Geometric Index, which is made up of 2,900 US companies equally weighted, so the average stock having just broken out of about a 4-year consolidation phase after previously coming out of, a 26-year long-term bear market for the average stock. So all of these things were kind of in place and in process coming to the election. Of course, things have followed through. So when we look geographically, Asia Pacific positive, Europe positive, Canada, some of Latin America positive, China more positive than it's been in a long time, Japan positive, lots of strength around the world. Now, over the course of the week, frankly, the bullish percent of stocks in uptrends globally came down to very slightly. I think obviously there is some concern around the impact of potential tariffs. We'll see. There's a lot of different ways that this can play out. And I think that the market does have some uncertainty around that. And it's something that we'll watch. But for the Canadian market, which arguably is a pretty close ally of the US, 1, 2, 3, 4, 5 months straight higher and outperforming the S&P now on the year. So TSX performing well. Now, part of that has to do with the sectors that make up the market and, frankly, some of the other global markets. But we've seen very strong relative performance now versus the US, which we think is positive. On fixed income, the beat continues. 10-year yields continue to work their way higher and higher highs and higher lows. And even really since the first rate cut in the early part of September, 10-year yields have been going higher. And that means bond prices have been falling. So we continue to be in a very tough market for bonds. Frankly, our view is you don't get compensated for inflation or for credit risk buying a bunch of treasury bonds. When we look at it on the year, treasury bonds are up 1-point-something% total return, coupon minus price. And that's, I don't think, compensating you for the risk of your purchasing power being devalued away. When we look at our income portfolios, we've focused since 2020 when rates bottomed on dividend growers, companies that generate tons of cash that don't need financing. So it doesn't matter really what the interest rates are, that are able to pay a rising stream of dividends to their investors. And that, of course, helps offset the rising cost of living. And, despite a sideways period in 2022 and early 23, when the market was going through its corrective period, the relative relationship of dividend growth versus the bond index is pretty clear. And this week had it was a punctuation point. So, year to date, things are going very well in our income strategy. We can be in any kind of income producing asset. The equally weighted S&P as of yesterday is up by 18.6, TSX up 21. Of course, those are straight equity indices, not really income benchmarks. The aggregate bond index up in the US up 2%. In Canada, the broad bond index up 3.67, tactical income portfolio up 21.95, and just about 40% since the middle of March last year. And we think that this is likely to continue. In commodities had a great leg higher from 2020 through 22. They most recently have started to move their way higher. They actually backed off a little over the course of the past week. There has been some strength in the US dollar. There are those that think that perhaps a Republican administration is likely to be more friendly to the US dollar. We did see a little back off in gold. Now we've had months and months straight higher, and we are extended away from the moving averages. It can certainly correct a little bit. When we look at silver, same thing, broke out of a big base, broke out of a second base, and has pulled back over the last couple of days. Again, very constructive looking price chart. We'll see where we go from here. And copper's pulled back a little along the way, but it's staying above rising long-term moving averages. So that remains to be seen. One of the big stories on the week, of course, what happened in Bitcoin. And I know not everyone believes in cryptocurrency, but the idea is it is a universal asset with a limited quantity. And there are those that believe that the purchasing power of paper currencies is being eroded by the fact that governments continue to print money. And for those that follow along, and we do own about a 10% exposure in our macro portfolio, we think that we are into a productive period. When we look historically, we had periods where it basically worked its way sideways like any asset, and then a big jump ahead, 1,700%. Then sideways for a couple of years, and then a move of almost 400%. Then sideways for 3 years, and we started a new move. It's up 35%, and everybody's talking about how much it's up over the last week. It's great that it's up as much as it is, but I think that's the beginning of a move, not the end. So these are all important asset classes that we have to consider, and our job is to try and identify the ones that are constructive and focus. We do have exposure to commodities. We do have exposure to Bitcoin. We do have exposure to equities, and in particular, dividend growth. And we really have avoided fixed income, despite the fact that with some folks that's unpopular. But if you're getting a 4% fixed income return and inflation is, as reported, 3%, or more likely closer to 6 or 7 if you use the 1980s calculation, and then you pay tax, you're guaranteed to lose money. So it's not an asset we've been focusing on. So ideally, we're trying to construct a portfolio that's relevant in the current market. Our job is to identify market leadership. That could be specific sectors or themes or geographic regions. I think people are paying us a fee to get them in front of the important revaluations or opportunities. We're always looking for change, new leadership to emerge or old leadership to recede, so that we can make sure we're transitioning our portfolios. That's part of the review process. The absence of leadership, I'm very happy to sit in money market funds or T-bills, but those are not the productive assets. Currently, our job is to be tactical. So from a top-down perspective, we believe 70% of return comes from getting in the right neighborhood. So we take all of the asset classes and sectors and themes we could focus on and identify those that are seeing net inflows of capital. Those are the productive parts, things that are being revalued. We identify those by trying to find parts of the market where over time a higher and higher percentage of individual securities are performing well or rallying, making higher highs and higher lows. That's constructive. And similarly, from time to time, things start to deteriorate. From a bottom-up perspective, we take all of the various securities that we could look at that are liquid and of high quality, that meet our business tests, and try to identify securities that we consider to be good getting better. And there's always a few. Sometimes there's more than we can own, and we have a farm team, companies we'd like to own. But where we can find securities that meet our business tests, and they are in parts of the market that are seeing net inflows of capital, well, this is where our portfolio should lie. We're addressing all of the factors that drive return. And the last piece is we have a real importance that we put on selling strategy. And frankly, we haven't had to do a lot of selling recently, although we have done some. And what we look for are groups that have been strong, where over time, fewer and fewer securities within the group are performing well. So the weaklings are peeling away. The leading stocks may look good, and we're happy to own them so long as they are performing well, but we don't add anything new within sectors where breadth is deteriorating. Because ultimately, if it gets bad enough, it can impact all of the securities, and that's relevant in some of the important groups today. So in the absence of leadership, we'll hold cash, we'll use stop losses, and to the extent that new money comes in, it's going to stay on the sidelines. Okay, so let's look at today. As of last week, about 48% of stocks in the US were in long-term uptrends. As of today, we are through 50%. So we've seen a nice improvement in breadth over the course of the week. The percent of stocks trading above their 50-day moving average moved up about 6% over the course of the week in the US and globally. Percent of stocks with positive weekly price momentum or upward trajectory expanded as well. The percent of stocks hitting new highs versus those that are hitting new lows moved higher to the right. And the percent of stocks trading above their long-term moving average, 150-week moving average, moved up to 66%. Now, last week, we talked about the fact that so long as the percent of stocks trading above their long-term moving average stays consistently within a range in this upper bound area, it means there's lots of stocks doing well. And to see what deterioration looks like, this is what happened through 2021, leading into the 2022 bear market. Well before the market peaked, there was internal deterioration, meaning fewer and fewer stocks were doing well each day. No sign of that currently. This can go on for a long time. Or if it starts to change, our job is to recognize it. But as it sits right now, this was the way it was on the way into the election, and it's been improved on the way out. In the NASDAQ, we highlighted that actually it hasn't been quite as friendly. There's a lot of great performing stocks and some that are less so. But across the board, the whole market is benefiting from the fact that we are now into the period where US corporate share buybacks are really in gear, having come out of the earnings period. Now, going in, we talked about some of the themes that might be relevant depending on the party that comes into power. We felt that many of these were satisfying what was happening in the market. So thought the market was probably leaning a little bit more Republican. And when we looked at sector leadership, that certainly was the case. Financials have led the market all the way through the year, and they continue to march higher. Again, another very good month this month. We've talked a lot about insurance along the way, our companies like Fairfax and Reinsurance Corp, Progressive. Well, the insurance sector made a new absolute high this week, and that's really constructive. We talked about the big banks, and we talked about JP Morgan a bunch of times over the course of the year. Rising relative strength versus the S&P, meaning outperforming, trading better than 84% of companies. Look at this move on the day after the election. Rarely will you see a stock like JP Morgan up more than 10%. We noted that the percent of stocks trading with positive relative strength versus the S&P was expanding going into the election, and that in the 2016 election, you got really good outperformance in mid-cap companies and regional banks post-election. And look, this is exactly what happened. Capital markets banks had a big jump on the day after the election. You can see nice sharp rising relative strength, meaning they're performing well. Goldman Sachs, one of our biggest positions, better than 90% of companies in the market, had a huge day the day after the election. Expectation we'll see more mergers and acquisitions. And then James was on last week to talk about regional banks and the fact that we had entered two key positions. They happen to be the two largest positions in this regional banks ETF, Regions Financial and M&T Bank. Both had great weeks. MTB was up 13% the day of the election, and Regions Financial up sharply. So these continue to kind of perform. We've talked a lot about industrials. And look, industrials really had a fire lit under them after the election. They've continued higher from there, rising relative price strength versus the market. We talked about adding Caterpillar. We own GE Aerospace. We've got defense weight. And you can see the sector marching higher above all the moving averages. We talked about Crane 2 weeks ago. It had a good week. We talked about MDA, the company that makes satellites in Canada, that has a deal, it looks like, to supply more satellites for low orbiting telecommunications. We talked about Motorola Solutions last week as a company we thought would benefit from an increase in spending on law and order. And then after our call, we added a position called Axon Enterprise. And again, this is a James Callahan special. We've owned this previously. Axon makes body cameras, they make tasers, they make security cameras, and they make software that uses AI to allow police forces to write reports in a timely way without taking a lot of time for the police officers to have them off the street. This was a huge winner, up 25%. As James said, sometimes better to be lucky than smart, but I think he was both. So industrials continue to perform really well, and transports, broke out of a range they've been in since 2021. Again, these are all things that point at things more at the beginning than the end. When you have the Dow transports and the Dow industrials making a new high in the same week, really what that means is the market believes that not only are goods being produced, but they're being shipped, not piling up in a warehouse somewhere. So that's an old theory, the Dow theory. All of those constructive going forward. Talked a little bit about materials and how materials look to be set up to do well in a less regulated world. On the day after the election, the metals and miners ETF broke out to new highs. Now, frankly, this had more to do, I think, with steel and steel making coal than copper, but certainly that's, again, quite cyclical by nature. And the energy companies, the Canadian long-lived energy producers, actually held in remarkably well, despite the fact that oil prices have been relatively weak. Now, post the election, clean energy, which was weak coming in, really got hammered. These are all the companies that do solar and wind. This has not been a focus for us. We have been focused on energy infrastructure for obvious reasons. The sector has been performing quite well. I asked James to come on today to talk about one of our newest adds to the portfolio, which we added in the middle of last week. And it's a company called Cheniere Energy. The symbol's LNG. And from the technician's perspective, a chart that trades sideways from 2022 through 24 and starts to break out is relevant, because now every stakeholder is happy. Something's changing. So James, tell us a little bit about Cheniere.
Yeah, thanks, Dave. I'm happy to. So maybe I'll spend some time just on the setup to start, because I know some on the call might not be as familiar with the energy space or haven't thought about why LNG is important recently, because obviously the US, Canada as well, but the US is a big producer of natural gas. It's cheap. It's a relatively clean form of energy. The US produces and consumes a lot of gas. Natural gas as a source of electricity makes up about half of utility scale power generation in the US. And it's a huge part of US energy independence and why energy is cheap in the US. Crude is pretty easy to export, but gas really isn't. It wasn't until the ability to liquefy gas was developed and scaled that gas was able to be transported transcontinentally. It used to have to go through pipelines. So the US produces a lot of gas. They have an LNG industry that's grown substantially. And from a geopolitical standpoint, Europe always should have been a massive customer of US LNG, but it was cheaper for them to get gas from Russia, transported by pipeline. Obviously, that's not an option now. So US LNG exports have grown, but there are large markets that have still chosen to go a different direction. And the bull case on LNG now is that the Trump administration will use US LNG as an instrument of foreign policy. So the market should grow substantially over the next 4 years. The way that we've chosen to play it right now, as you say, we just got involved last week, but this is probably a theme that we'll talk more about because it does seem like it'll have legs. The way we've chosen to play it right now has been through ownership of Cheniere. It's a name that we're familiar with. We've owned it in the past. We bought Cheniere in our equity and income mandates last week. They're a pure play LNG name. So as everyone can see on the screen, they operate 2 liquefaction sites on the Gulf Coast. And they're one of the best ways to play LNG proliferation right now. So there isn't too much torque in Cheniere. About 85% of their capacity is locked into long-term supply agreements, but they do leave about 15% of capacity priced at spot, which is subject to move higher as demand increases. But the real opportunity for them is to grow capacity as LNG demand increases globally. So the company pays about a 1% yield, but they've grown their dividend 80% in the last 3 years. That we like that, good dividend growth. They only began paying a dividend in 2021. So, a name like Cheniere, these are examples of the types of companies that we're looking for. Well run, we know them. We've owned Cheniere in the past. It's an industry that's about to see a big positive inflection. So that's what we like to see. We feel good about this position. In terms of ways to get exposure in Canada, we're not there yet because some of these names, they don't meet what is right now a really high bar for inclusion in our portfolios, just given the way things are. Things look really good. But I'll say these names are on the farm team. So Arc Resources and Tourmaline, both of these companies have supply agreements with Cheniere. So they're able to get LNG pricing on a portion of their production, which should help them on a relative basis going forward. So I'll just make mention of that as well from a Canadian standpoint.
So look, things continue to move along, and it is likely that a Republican administration is more friendly to liquefied natural gas. Geopolitically, we know there's a need. Europe needs more energy, and Cheniere right now has a choke point on exiting liquefied natural gas in North America. So it should be an interesting addition, and certainly the market seems to agree over the last few days. Moving away from energy, we thought last week that the communications sector, led by companies like Meta and Google and Netflix, would be beneficiary of less antitrust and less oversight. The sector had a very strong week. Netflix, really lifted out of the 2 or 3 weeks that have been trading sideways, and so we feel pretty good here as well. We talked a little bit about utilities over the early part of the summer as being a beneficiary of some of the additional demands for energy. They are a more defensive asset that did start to wane a little bit. We saw the sector break the 50-day moving average. Our position in NEE NextEra, we moved away from over the course of the week. Just weak relative strength. I don't like to see significant underperformance when you go through a catalyst in the market. From a consumer perspective, consumer discretionary sector has been sort of sideways relative to the market. Certainly consumer staples, this is an equally weighted basket of consumer staples companies, has been a significant underperformer. What did happen over the week is that we had some of the consumer discretionary companies, act better. Costco had a great week. And if we look at comparing the consumer discretionary equally weighted ETF to the consumer staples, you can see that, really the logjam looks like it's breaking in favor of the consumer discretionary companies. So we don't have a lot of exposure there, but that's certainly an area that we're looking at. As I mentioned, clean energy is something that we don't own. In fact, we're short in our macro portfolio and have been. Healthcare continues to underperform. We have close to a zero weight now in healthcare. And in tech, while there are some great companies, we do note that we keep on seeing some deterioration internally, or the percent of stocks trading above their 200-day moving average has been declining. So while technology as a group relative to the S&P has been about sideways, there's been a lot of money that's come out of this sector. Now, most of we have had an underweight position now since the spring. We are about 12% versus close to 30% in the S&P. We've just gone through the 4 biggest weeks of money leaving the tech sector that you can find going back over the last 20 years. So we think that's important. The semiconductor sector has been relatively underperforming since June, with notable exceptions. We talked last week about the fact if you took NVIDIA and Broadcom out of the semiconductor index, it's been a very weak sector. In fact, when we look at the different groups, and the percent of stocks trading above the 200-day moving average or long-term moving average, semiconductors and equipment is about the worst. So that causes us, to look hard at the group. Also, in the period of tariffs in 2018-19, semiconductors were impacted. Now, as it turns out, NVIDIA appears to be able to sell almost everything it can in the US. We really pay for almost no business with China because they have been significantly limited already. So it is significantly outperforming the group, better than 96% of companies in the S&P. And in fact, I think traded virtually at a new high today, and it's just coming out of a very nice sideways base. And Broadcom, frankly, has been, trading quite well also. So we're watching these very closely. We know that we have earnings coming, Broadcom in 25 days, NVIDIA in 8 days. So we're going to learn a lot more, but I do like the way that NVIDIA is trading on the way in. So just to summarize, from a sector perspective, over the course of the week since the election, the average sector added 5% to the percent of stocks in uptrends. We moved from 45% to an average of 50, meaning that groups are moving to the right here. The groups on the farthest right have the highest percentage of stocks in uptrends. Banks right at the top here, insurance companies, capital markets, savings and loans. Those are all financials. That makes sense that that is the case given where our weightings are. Machinery and aerospace, industrial companies, and transports having turned positive in capital letters this week. The ones on the hard left are the ones that have been performing the worst. Notably, actually, housing companies in the US had a weak week. So that's something just to keep an eye on, the consumer, but healthcare largely in the weakest. It is a market where the cyclicals are outperforming. So what does that say to us? It says to us that the market has been leaning toward the next economic cycle. We are in a rate cutting environment. We want to own companies that benefit and that have pricing power. From a sector perspective, our large weighting in financials actually got larger over the week, almost 28% of firm assets, made up of insurance companies, banks, and regional banks. We added the Axon in the industrial sector over the past week, so our weighting increased here, significant overweight versus market. Our tech weight continues to be quite low. Our energy weight has been constructive, and we've enlarged a lot of this as energy infrastructure. And of course, we've added Cheniere, which increases our weight this week. Materials treaded water over the course of the last week or two. It's something that we're going to watch. Certainly, the golds have been a great place to be over the course of the year. They've had a breath over the last week. And when we go down to the bottom of the chart here, healthcare you can see is almost nothing. Real estate is almost nothing. Consumer discretionary is very low. Utilities relatively low. So the defensives tend to be less important. We want to highlight we are in the early stages of a liquidity cycle. Global central banks are cutting rates, and that's going to go on for a while. We're through the second rate cut in the US. Historically speaking, outside of a couple of very obvious exceptions in 2000 and 2009, where the market got very difficult, there's no signs of breadth deterioration, which would point to that. So historically speaking, since 1950, once you got 2 rate cuts, the market performed pretty well. Credit markets are benign. The excess return bond investors are demanding to take credit risk has been falling. It means they're comfortable with credit risk. Economic surprise, the number of economic releases that are coming in ahead of expectation continues to rise. I mean, the economy is getting a little better. And volatility, I've marked out this level going back through all of the previous period. These are the mid ranges of the most constructive stock markets that we've seen going back to 1990. And this is exactly where we are today. So we continue to be constructive. The S&P is up 5% in the month of November. The backdrop continues to be friendly. We expect more share buybacks. We think that there are a lot of people who frankly got very defensive going into the election, concerned about what the outcome might be. There's a ton of money sitting in money market funds. And there's certainly stocks that are stretched that can consolidate. But the fact is, if you took all of the years going back to 1980, this is the best year-to-date gain for this time of the year since 1995. So you say, well, okay, that means it's an outlier. What does that mean? Well, 1995 was followed by 96, 97, 98, and 99, 4 great years. So we're 2 years into a bull market. We may have 3 more years before we run out of gas. The average bull market, once a bull market got beyond 2 years, was 5.5 years. We talked about some of the statistics last week, and it looks like there's room to go. We think we're relatively early on, and we think that the positions and sectors and themes continue to act well. So we're heading into the strongest 6 months of the year, and we've come from a very strong base. We'll continue to watch things as they go forward. If things get difficult, we have shown a willingness over time to get very defensive. We are not perma bulls. It sounds like it because we've been pretty bullish on the market over the last 18 months, 2 years. But should things start to get more difficult, we will raise cash. We will exit parts of the market that aren't working. We will put money on the sidelines, but that doesn't appear to be the case today. So with that, why don't I see if we've got any questions today? Let me take a look. Lawrence Knight, what are our thoughts re gold and gold miners? As I mentioned earlier, gold's have had a great run up over the course of the year. They pulled back a little over the course of this week. There is absolutely nothing that suggests a trend break. I think that it probably is a shakeout. US dollar was firm over the course of this week. And so you saw gold pull back. You saw most commodities pull back a little bit. The big chart price patterns are very, very supportive. I would be a buyer on any kind of weakness here. So what were we selling to buy the new additions to the portfolio? Anonymous attendee. We mentioned last week that we had exited Nextera in the utilities, and we also mentioned that we had exited Lilly and we exited Regeneron. So 2 healthcare weightings. And so we did have a little cash coming into last week. We're being asked by another attendee, any idea why consumer goods like Procter & Gamble and Nestle have been weak since the election? Is it tariff related? I think the message coming into this election was the market was focused more on risk on than risk off. Right? There are those times when you want to own defensive oriented assets that are not economically sensitive, that will not get hurt as badly if the market gets difficult, that pay a high dividend and are not economically sensitive. Very clearly, the message of the market coming into the election was cyclicals were leading economically sensitive stocks. And we got a Republican Party win, and their policies are more likely to be friendly to more cyclical or economically sensitive sectors. And so, frankly, if you're looking at a portfolio and maybe you're lagging a little bit, you're more likely to reduce the defensive positioning and add some offense. There's a tremendous amount of put buying or betting on a falling market heading into the election, which turned out not to be right. So I think that's why the consumer staples companies and utilities and real estate investment trusts, things that are more defensive, have had a more difficult time. And the last thing is, what do you make of hedge funds reducing market exposure en masse? I think that there was a lot of people putting hedges on in their portfolios leading into the election, concerned that an outcome might not be friendly to the market. Now, what that means is that they missed one of the best days of the year, and frankly, the best post-election day going back to 1950. So my guess is there's a lot of people who are going to have to chase the market from here to year end who have been underpositioned or maybe lagging. Frankly, very few people are leading the indices this year, because for the first half of the year, it was all the very large cap stocks that were leading. And in the second half, it's been a much broader market. So we'll see. But my guess is market's on pretty good foot. We'll watch for change. You'll hear what our thoughts are next week. Today was a bit of a digestion day, but frankly, things that were weak in the morning clawed back through the course of the day. And we think that the market is behaving, in a really constructive way. So with that, if there's no more questions, well, there's a couple of more. Carol is asking, is Bitcoin the new gold? I think that people own them for similar reasons. When we look at what central banks have been doing over the last 4 years, they've been ramping up their purchases of gold. So that has been a reserve asset. We think that there are lots of individuals who have been buyers of gold as well, but frankly, sentiment has not been robust in precious metals. And as you know, Bitcoin went through a long sort of crypto winter leading up to this year, and is certainly seeing some buying since the election as the Republican policies are a little more friendly to cryptocurrencies. I think that in some ways they're both attractive. There are people who look at Bitcoin and say, look, it's not heavy. I don't have to store it in a vault somewhere. It's hard to take gold across borders. Bitcoin is not the case. Of course, you can lose it and it can be gone forever if you don't store it properly. There's pluses and minuses, but both of them are scarce assets that can't be printed. And there is real concern, I think, that governments continue to print money. If you follow M2 money supply, it's up about 7% on the year. It means there's 7% more money in the system than there was a year ago. That's why we have inflation. So I think they both play a part. Probably for younger folks, Bitcoin's more interesting. For older folks, gold is interesting. For central banks as it stands right now, gold is the asset. But even the Republican administration has said maybe there is a case to hold Bitcoin as a reserve asset. The last question was, do we own Chubb? And we do not own Chubb. We have owned Chubb in the past. We've been more focused on other insurers. I think it's an excellent company. And that's about it. There's a question on oil and energy prices, where they're headed in the next 6 to 12 months. Oil is not so constructive. Most of the energy companies that are like shale oil and gas producers, don't look that great. But we do think that the long life assets are attractive. We think that their CNQs and Suncors and Imperials of the world, with their very long reserve lives, are very attractive for their dividends and dividend growth and cash flow. So we'll see. I think that's it. Thanks everybody for joining. We look forward to doing it again next week. If you've got questions that we haven't answered, please reach out. It's been great. I've had a great back and forth with a bunch of people who've been watching these webcasts. People, don't be shy to reach out. And as always, we're in the business of growing our company. We've got about 200 families that we take care of, and we think they're wonderful folks. And we enjoy our relationships with them, and we're trying to build a stronger, better company as we go. So we're always happy to talk to new people. James, thanks very much for joining in, and we'll see you all next week.